Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become Google Map for hardworking Canadians seeking financial freedom. Recently, there is this court case that came up. It has the headline, "Taxpayer who hire mother-in-law, wife as assistants, gets pushback from CRA." And this headline just came up a few days ago. And essentially, what the taxpayers was trying to do is to try to split income with the mother-in-law and also lower income wife as well. So then he gets to pay less tax. That's the whole idea behind it. So income splitting, like I mentioned earlier, is one of the most effective strategies available for Canadian taxpayers to lower their overall family tax liability. Now, this is really because we operate, our personal income tax system operate on this progressive tax system. Essentially, the more income you earn, the more tax you would have to pay. Now, let's take a quick look. I have another video that goes in depth, but I'm just going to quickly show you what I meant by the more income you make, the more tax that you would have to pay. Essentially, our tax system would divide up our income into different chunks, different tax brackets. So from $0 to $11,865, you pay no tax, no provincial tax, no federal tax at all. That delta of $12,000 roughly is subject to 0% tax. Between $11,865 to $15,000, you are required to pay Ontario tax. We're talking about Ontario tax rate here. You need to pay 5.05% tax. And the delta between $15,000 and $11,865, the delta of $3,135 is subject to 5.05% tax. The Ontario tax rate. So in this example, it would be $158 that would be charged on that $3,135 delta. And basically, these tax brackets will keep going, and so as the marginal tax rate that would be applicable to that particular tax bracket. So for anyone who make more than $235,000, which is the highest tax rate in Ontario, anything above and beyond that $235,675 would be subject to 53.53% tax. So in essence, anything that you made over $235,675, you will be keeping less than what CRA would get. So it kind of sucks because anything above that number, you practically get to keep less than what CRA would do. So that's what I meant by a progressive tax system. The more you make, the more tax that you would get paid. Let me just ask you a quick question. Two different scenarios. Family one, husband works in a big company and makes $200,000, and the wife gets to stay home taking care of the two young children. Now we have family number two, both husband and wife work at the corporate job. Each of them are making $100,000. So combined, they make $200,000. Family one, husband works full-time, wife stay home, making $200,000. Household income, $200,000. Family two, husband and wife each work and each make $100,000. Combined total family income is $200,000. Which family get to keep more in their pocket at the end of the day? Okay, under scenario number one, family number one, the husband works full-time, makes $200,000. Because he's making $200,000 all by himself, he would be liable to pay about roughly $67,000 of income tax on his personal income tax return. Now, on the other hand, family number two, they have both husband and wife working together at corporate job, each making $100,000. Each of them will be responsible for $22,000, roughly $22,000 of income tax. Because remember we mentioned earlier, according to our marginal tax rate system, our progressive tax system, every single person in Ontario, as long as you are Ontario tax resident, you're entitled to the low marginal tax rate and the low marginal tax bracket as well. So when you're receiving $100,000, a large chunk of your income is being taxed at the lower tax rate from 0% all the way to 34%. Whereas for someone who's making $200,000 income, that person will be subject to a wide range of tax rate from 0% all the way to 48.29%. So it's not surprising that under scenario number 2, family number 2, each spouse paying $22,000 and the combined tax payable for the entire family is $44,000. And if you compare a single family income of $200,000, the husband would have to pay $67,000 of tax versus someone who has the husband and wife both working at corporate job, paying only $44,000 combined tax payable. You would have a total tax saving of about $23,000. You would net $23,000 by having the income being spread between the husband and wife, each earning $100,000. It is no wonder why a lot of tax accountant out there, as well as tax lawyer out there, trying to use income splitting as a strategy to lower the overall family tax liability. Now, this is also the case with the actual court case that we mentioned that made the National Post headline as well. Well, as a matter of fact, this particular taxpayer works as a general sales manager and finance service manager at the car dealership in 2015 and 2016. And so the court case is actually related to his 2015 and 2016 taxation years. What had happened is that in those 2 particular years, he make about employment income about $110,000 in range, including annual commission income about $75,000. When you make commission income, generally speaking, you're allowed to deduct certain employment expenses that allow you, encourage you, that enable you to earn that particular employment income. In the year 2015, this particular taxpayer claimed $24,000 as an employment expenses, and this $24,000 salary that he claimed it as a deduction, and he claimed it as the salary paid to his mother-in-law to help him to complete the paperwork that's required under the role of finance service manager. And he paid his mother-in-law to complete all the tasks at home for him so that he can submit it to the accounting department for processing. He claimed that he would not have enough time at work to complete all the tasks, and that's the reason why he paid his mother-in-law $24,000 for the year to complete all the paperwork. Now, in 2016, instead of paying his mother-in-law, he now claimed another $24,000 deduction. He claimed that he paid it to his wife in 2016 to do the same task that his mother-in-law used to do, and essentially helping him with all the paperwork. And he claimed it as employment expenses. Now, for those of you who don't know, using 2023's income tax rate for this particular taxpayer, he makes $110,000 from his employment income. If he doesn't claim the $24,000 of salary that he paid to his spouse or his mother-in-law, his tax payable would have been $26,000. So that's pretty standard, pretty substantial, but also pretty standard. Now, by paying his mother-in-law or by paying his spouse $24,000, he now, instead of having $110,000 as his taxable income, he now has $86,000 as his taxable income. And because the taxable income is lower, his tax payable is now reduced to $17,700 roughly. Now, assuming his spouse or his mother-in-law has no other job, his mother-in-law or his spouse in 2015 and 2016 would only report at $24,000 of income. So then that $24,000 income became the spouse or the mother-in-law's only source of income. And if that's the case, remember the lower the income, the lower the tax rate would be. So his mother-in-law or his wife, assuming with no other income, would only be liable for roughly about $2,000 of income tax payable. The combined between $18,000 of tax payable incurred on the husband's side and the spouse or mother-in-law side, the combined total family tax payable, the combined family tax payable would have been just under $20,000. Now, if he didn't split the income with the spouse or mother-in-law, he would have been liable for $26,000. Whereas if he split the income with his spouse or mother-in-law in different taxation year, he would have only incurred $20,000 of tax payable. So the total tax saving in this scenario would be about $6,300. So that's still quite a substantial amount on an annual basis by paying your mother-in-law who's not really making any other money, or by paying your spouse who has no other income. This is how powerful income splitting is. Now, unfortunately, CRA disagree and push back. And you may wonder why, and how do you do that legitimately so CRA cannot challenge you? So what happened is that in the court case, in the informal procedure hearing, the taxpayer did not have the wife or the mother-in-law come into the court to testify for all the work that they've performed for the taxpayer. So to income split properly, there are rules governing income splitting. As you know, because you get to save a lot of taxes, CRA often look in detail in terms of what you have done. There are a few things that CRA actually look at. The first thing is documentation. Do you have proper documentation to justify the work performed? For example, the hours done, the amount, the type of work that's being performed, those are the documentation. Number two, are there any money changing hands? Are you actually compensating someone, compensating your mother-in-law? Are you really compensating your spouse for the work performed? And then the third thing that CRA look at is the reasonability. Is the amount being paid for the work performed or for the hours performed reasonable? So they look at all these things. Now, for taxpayers who are employees, such as in this case, the taxpayer is an employee working as a finance manager at a car dealership. For employees who are trying to deduct salary to an assistant, you also are required to keep further documentation, including this form called T2200 form, which is essentially employment condition that being signed off by the employer, as well as the employment contract, specifying that you're required to hire an assistant to perform your duty. So all these things matter when it comes down to documentation, when it comes down to qualifying you whether you would be able to pay or deduct the income expenses paid to your spouse or your mother-in-law. Now, in this particular tax case, the taxpayer claimed $24,000 paid to mother-in-law, claimed $24,000 paid to the spouse in the second year. In the second year, the reality is that he doesn't have the documentation of the work that's being performed. He didn't track the hours. He paid each person, he claimed he paid $24,000. He doesn't have the justification to prove that the amount of work actually justified $24,000. So there is no reasonability at all. And most importantly, there is no money changing hands. So he claimed that he paid his mother-in-law by way of not having her to pay him rent because they live all together in the same household. He would have charged his mother-in-law rent, but because she's volunteering or working for him, he's using the amount of payment that he would otherwise need to pay for her salary to offset against the rent that she would otherwise have to pay him. So there is actually no money changing hands. He's just claiming that the expenses are being offset against each other. So that's big no-no for CRA altogether. Now, in terms of paying his wife, he claimed that because the money came to the same pot, they share the same joint account, there is no actual money being transferred from one bank account to another. Under that scenario, we typically advise our client to open a separate bank account for the spouse so that we can actually track the transfer of cash. In this particular court case, the taxpayer didn't have two separate bank accounts, and he claimed that one account is being used and the same salary goes into the same account to pay his wife and him all together, therefore no money is changing hands. CRA doesn't buy that at all, and therefore the amount is being disallowed. Now, lastly, as I mentioned before, because this court case related to employment deduction and this taxpayer is an employee, he is required to have the T2200 form signed off by his employer. He has to be required by his employer to claim to use an assistant to complete his work. He has to have that type of employment contract in place to enable him to deduct the expense, but he doesn't have any of that. And this is the reason why he would not be able to claim the employment expense at all. Now, in summary, the most important part is that if you were to try to split income with your significant others or lower income family members, it's very important to have the documentation, including the type of work that's being done, the hours of work performed, the nature of work performed. Number two, you also need to have the money transfer. You cannot just say that randomly pick a number out there and then not transfer the money at all. You need to have the money changing hands, have separate account. Number three is that the amount being charged and being split has to be reasonable. What's considered reasonable? What you would otherwise pay a third party to do. So then that would be the amount that would be reasonable. And lastly, if you're claiming this as an employment expense, you need to have the T2200 form, and that form has to specify that you require an assistant to help you to finish the job. If your employer is not signing off on that form, specifying that you require the employment contract requires you to hire your own assistant, you would not be able to claim that as an expense. Now, if you like our video, make sure you give us a thumbs up. If you find it useful, make sure you share that with all your friends and families and everyone else. And until next time, happy Canadian real estate investing.